Hello again. Remember me from the IAS 12 Income Taxes Part 1 course? Welcome to the IAS 12 Part 2 course, which will focus on the accounting for deferred tax. It's good to see you again. Before we get started learning about deferred tax, let's take a few minutes to remember the overall objective and scope of IAS 12, as well as a brief reminder of what you learned in Part 1. If you're just joining us to learn about deferred tax, that's fine too. We'll get started in a minute. Remember that IAS 12 applies to all entities in the accounting for income taxes. This includes domestic and foreign taxes that are based on taxable profits. The objective of IAS 12 is to prescribe the accounting treatment for income taxes, for which the principal issue is how to account for the current and future tax consequences of future recovery or settlement of the carrying amount of assets or liabilities that are recognized in an entity's statement of financial position, and transactions and other events of the current period that are recognized in an entity's financial statements. Therefore, income tax is comprised of two components, current tax and deferred tax. Current tax refers to income taxes that are payable or recoverable in respect of the current period's taxable profit or loss. Said another way, this is the amount the entity owes the government for the current year. For the most part, this comes from the entity's tax return, which is rooted in the tax code. But IAS 12 does provide a few paragraphs of guidance in the accounting for current tax. In addition, IFRIC 23, which focuses on uncertainty in income taxes, may also impact the recognition of current tax in the financial statements. You learned about the accounting for current tax and uncertainty in income taxes in Part 1 of IAS 12 Income Taxes. Deferred tax refers to income taxes that are payable or recoverable in respect of future periods. But what exactly does this mean? It is inherent in the recognition of an asset or liability that an entity expects to recover or settle the carrying amount of that asset or liability. If it is probable that the recovery or settlement of the carrying amount will make future tax payments larger or smaller than they would be if the recovery were to have no tax consequences, then IAS 12 requires the entity to recognize a deferred tax liability or asset with a few exceptions. Another way to look at this is that IFRS rules and tax rules are different, and the timing of recognition and recovery of assets and liabilities is often different, meaning that there are items that are recognized in the financial statements before they are recognized in the tax return, and vice versa. Since IFRS requires accrual basis accounting, the tax effect of these items must be considered, resulting in the recognition of deferred tax. IAS 12 provides a significant amount of guidance on the accounting for deferred tax assets and liabilities. IAS 12 also deals with the recognition of deferred tax assets arising from unused tax losses or tax credits, as well as the presentation and disclosure of income taxes. After a brief reminder of the scope, objectives, and basic principles of IAS 12, you will learn about the accounting for deferred tax, as well as the presentation and disclosure requirements related to deferred tax. Let's get started.